opened our new office in Pune this morning. It took a little bit longer than we had anticipated, and we had a couple of clients with us. Secondly, apologies for the slight power outage that just occurred. I'm hoping that won't persist during the meeting. If it does, I'm sure we can answer some of your questions as we go on. It is a genuine privilege for me to be addressing you this morning. I know how busy the press are in India, given everything that's going on at the moment. In particular, I know that many of you have had to travel from Mumbai. So I want to take this opportunity firstly to thank you for your time. It's enormously important for us as a business, both globally but also here in India, that we're able to tell our story in a particular way. So I appreciate your time and your focus this morning. The plan of attack this morning is to very briefly give you an overview of who we are as Pepper Advantage as a global business. We would then have Mukund introduce a little bit about the Indian operation, and then finally we'll talk about why we've opened the tech hub here in Pune that we have. I understand there's going to be time for some questions, both formally up here and then also subsequently to the meeting as well. So I do really appreciate your time. It's a great honor to be here, and I hope you enjoy the next half an hour or so. So we have a
hectic in terms of the pace of growth that we have witnessed. So from 12 clients we moved to 27 clients within the span of 12 months. From a portfolio of say 600 crores, we have moved to 2,000 crores in the span of last 12 months. Such has been the demand in the Indian market for a corporate player like Pepper, is that there's a big queue of clients who's wanting us to speed up the whole deployment of the entire infrastructure throughout the country so that they can sign up and we start working with them. Given the appetite of the whole market and the demand of the whole market, what we envisage for the Indian market is that it is not going to be a linear curve kind of growth, but it's going to be an exponential growth for at least the next 3 to 5 years. So the number multiplies, it doesn't go as a small curve of 10, 20, 30, 40%. It moves in an exponential manner. And that's the very reason why everyone today is looking at India in terms of opportunities. I would particularly say that, very proudly say that, the whole idea of the reverse migration, which we used to talk probably around 5 years, 10 years down the line, saying that there's going to be a phase in the Indian economy where the reverse migration of talent is going to happen. I bet my tongue on that and say that this process has started. You will see the kind of economic growth. Probably you heard the finance minister revise the GDP growth rate upwards last week. The RBI's annual report suggests a triple-digit kind of compounded growth rate on the retail business. There's no other country in the world who's going to give this kind of growth opportunities. Not even China cannot match the current growth rate that India proposes. So what we can do in India is immense, and Pepper Advantage India is actually gearing itself up, putting the necessary infrastructure in place. We've started 5 hubs. We're coming up with 3 more hubs. The technology hub is going to be the key, very important aspect in enabling the whole business. I keep on saying that the late 90s and the early 2000s saw a transformation in the banking industry. The way we used to do banking moved to people coming and knocking at a door to do banking. That was a transformational change, a tectonic shift in the whole banking industry. This is the second tectonic shift that we are going to witness. The whole digital banking environment, the technology environment that is going to change the entire finance, the retail finance, and even the MSME finance. I think the whole idea is that we are ready to encash this whole opportunity through this tech hub that we are trying to set up. Thank you. Thanks.
Of a business called Reom.ai. It's got a core product called LoanGuard, which currently assesses about 100,000 accounts per month on behalf of 18 different clients. We've grown it in the last 6 months by nearly 50% in underlying volume month on month. So it's a hugely important acquisition for us, and one that is allowing us to really begin cross-selling our core offering into the various relationships that we have. But the Tech Hub for us is much more than just a place for our people to sit that we acquired through Reom.ai. This is going to become really the unit that we build our global technology offering from. We have developers and technologists sat in a number of our jurisdictions, London, Madrid, Jakarta, and Mumbai. With Pune, however, this is where the largest element of our wider development team is going to be sat, and they're not just going to be working on Indian-related technology initiatives, they're going to be working on global activities. And even before we opened today, they've been working on a number of initiatives across Indonesia and Spain. And we're looking to launch an AI GPT-related product into the UK in the coming months that was built by the team down here in Pune. It's a platform that we are enormously proud of. It's a platform we are hugely excited by. We currently have in there today a couple of dozen people. I predict that we'll be breaking 100 people within the next 12 to 18 months. I think we will run out of space very quickly, so I think our landlord's going to be pretty happy. But in reality, our goal is to build a sustainable, scalable, market-leading technology footprint, and it's going to be anchored off the talent that we have here in Pune. Okay. Thank you very much for listening. Looking forward to your questions.
I'm audible? Yeah. So we have 27 clients as of today. Out of that, 10 are public sector banks. We have private banks and very large NBFCs today who are actually onboarded as clients today. And our operations currently are live in 50 cities in India. We are very soon going to expand to another 50 cities.
I might just add to that point. We undertook a bit of a strategic acceleration of our aspiration in India about 18 months ago, and it became very clear to us that we needed to get a broader footprint geographically for us to be able to offer a service to our client base that wasn't just based on capital cities or tier 1 cities. So it was a big undertaking and a big investment for us at the time, but we realized that by putting 6 hubs in place, as Mukund alluded to, with another 3, allowed us to put local dialect, it allowed us to put local feet into the markets where we are serving. That in turn allows us to generate better data. It also allows us to offer a broader church of solutions to our clients than we would otherwise. So it was a big learning from our point of view. When we started here, we thought, okay, we might have a couple of sort of hubs, if you like, in the tier 1 cities. Actually, what we're doing is being guided by our clients, and we're locating footprints where they want us to be. And that is a pretty material development from our point of view, and it points to a pretty significant investment into the wider operation.
How many employees do you have in India?
Currently it's more than 350. We're expanding very fast.
Yeah, this is Geeta Nagar, Financial Express. My question is, this whole debt collection and servicing is a very cost-intensive business, right? So you have these local operators, small-time firms who come and collect and do it. So what advantage do you come out from a cost perspective? How effective is it? And are you going to replace that, or are you going to use that whole force that you have on the ground?
Yeah, I mean, that's the most relevant question. Thanks, man. There are 3 limbs to the whole process. Currently, if you look at how the local operators work, is that it's purely a people-intensive, work on the field kind of scenario. What corporates offer the banks today, because of the volumes that are into play, there are 3 limbs to it. One is the digital collections, second is the telecollections platform, and the third is the field execution part. So the current players, majority of them, more than 90% of this current local players, do only the field collections part. Telecalling, it's very assorted, few heads. But if you look at how the whole market is moving, how most of the banks, majority of the banks, including public sector banks, are moving their operations, is that they are centralizing the whole early bucket collections at one place. And this early bucket collections is being managed through digital channel and the telecollections channel. So whether local players will be moved out, no, if they comply with the regulators' requirements. They will require to invest in that. That's a challenge for the local investors, local players. But yes, there will be enough space for the existing players and large corporate players like us.
The whole fintech ecosystem is surrounding around the entire offering that you have, whether it is appraising or collection, whatever, the whole fintech thing. So what is it that you can do what a small fintech cannot do? I mean, what is it that, well, they have come and disrupted the whole system, right? Can you explain what a big company like yours would do?
Sure, I'll answer that if I can. One of the things that we are so attracted to about India is just the sheer scale of the financial services industry. It's just absolutely remarkable. 9,000 MBFIs, 3,000 plus fintechs. Our experience with fintechs in other jurisdictions is when they raise capital to invest in their own operation, it's typically very product-led, it's very front-end led, and very UX-led. So they're trying to focus on really the interaction and experience the customer has. Where we have found capital doesn't flow from a fintech point of view is into the back end. Why is that? Well, predominantly it's because it has been seen historically as quite a commoditized part of the financial services sector, i.e. you are running or managing a loan balance through a series of ledgers, but also because it's not seen by the borrower. Why invest hard-raised equity, particularly right now when the VC markets are what they are, into a part of the process that the borrower doesn't experience? As a result, what we've found is there is a significant amount of technology deficit that occurs, and what we are doing is focusing on where they haven't put their capital, offering them a variable cost but technology invested offering that allows them to enhance their capability. So I think the way that I would describe our offering, if you like, to not all, but certainly the majority of those fintechs, is we are an enabler, we're a partner, and we're a way to help them manage their risks in a more efficient way than they might need to do so had they been asked to put their own capital to work.
I have a follow-up question to this. Sorry, please.
Yeah, just to add to what Riz is saying is that you rightly mentioned saying that fintech is disrupting the lending business. How do we fit into both these? Traditional banking as the new disrupted lending model is that fintech is a tech-enabled lending business. They don't have limitations of geography as such, right? While a traditional banking has a reach and has a process both. But fintech is more cost efficient. They can lend anywhere sitting at one office. However, a corporate like Pepper is required by both kind of models, whether it's a traditional banking approach or a fintech approach, because fintech would sit in Mumbai and lend to a customer, say in Salem. How do I do the KYC? Suppose it's an affordable housing, how to go and verify it, right? They have a technology infrastructure, but they don't have a physical infrastructure to do a follow-up on that, because disbursement is just one leg of the whole lending business. After that, there are a host of activities: customer service, delinquency management, legal management. None of the fintechs today in India have that kind of infrastructure. Therefore, whether it's traditional banking or whether it's fintech, corporates like Pepper Advantage are going to service each of these models.
The recent RBI instructions on fintechs, where the lending is going to become a problem, especially the small ticket lending. So do you see, from your perspective, is there a problem in the small ticket lending and the collection part and management of those 30,000-40,000 rupee loans?
Yes, I mean the very objective of bringing in that layer, guideline was the delinquencies were probably trying to shoot up. What they're trying to contain is that it was a compounded impact on the balance sheet of the lenders, because the banks were lending to the NBFCs and the fintechs, but they were considered as secured loans. However, they in turn were doing unsecured loans. So the compounded unsecured loan was significantly larger than what was perceived as an unsecured exposure, and the cumulative delinquency was higher. So I think it's a step in the right direction. It helps contain inflation also to a large extent because of a contained lending environment. It makes even the borrower more responsible, because he knows that the cost of borrowing is going to go up if his own score, his credit behavior is not good. So I think while in the short term, the fintech lending may go down for the small tickets, yes it will, but over a period of time, as RBI sees or the regulator sees that the behavior has improved and the risk of delinquency rising sharply is coming down, I think they will ease it. That's all.
In your presentation, you specifically mentioned the people who don't have access and don't have ratings, and you help those kind of people. So in this kind of a scenario, where the regulator is looking suspiciously at the small size loans and that access is going to dry up, what can you do in that? How do you help?
So what we call them is the new to credit kind of segment, right? They have a borrowing habit, but that is done through a local money lender kind of environment. So the whole idea of setting up this tech environment is that apart from a typical bureau score, what we try to do is that we map consumers and their behaviors. Apart from the financial sector, as a consumer, we map his behaviors and spending habits on different aspects, not just on his borrowing abilities. We try to build a pattern and a score and then go back to the lender saying that this is a confidence level in the new to credit kind of segment or a pool. And we give them a comfort saying that if it goes wrong, we are there infrastructurally to help you correct it. So I think this combination is very essential. One is that give the lender a confidence saying that he has a better behavior, and if he moves to the organized lending sector, he will behave well. Give them a confidence on that. Second, also support them infrastructurally, saying that even if it goes wrong, because nothing can be 100% right. We are there to support you and help you correct. I think that's the way we are going to come as a player.
This is Smita from Pune Sarkar. Already we have reached in Asia, Europe and UK. What is our next future destination?
Wow, it's a good question. We definitely want to continue growing in this part of the world. For me, we've got such huge aspirations in India and such huge aspirations in Indonesia. Our focus will be really around building out our footprint and our foundations in both of those markets. If we move in any new jurisdiction, it will most likely be Vietnam. It's very close to the Indonesian market, and we have technology that we could passport from Indonesia into the Vietnamese market. We are very focused on the underlying macro fundamentals and demography of the markets that we move into. There's some very interesting statistics out as recently as this morning talking about the pace of growth that we're seeing in mortgage origination across the Eurozone, for example, which this year is going to be down to 1.25% year on year. You compare that to the same time period and the same product suite in India, which is running at between 13 and 14%. So we are aware of the generation of assets, which is the lifeblood of our business, is coming from the markets which demonstrate the demographic dividend, I think it's called by many commentators here in India, and also other Southeast Asian markets. So for us, it's about refining our technology offering and our data and analytics offering in order to do that. And I think it also goes to the prior question. One of the reasons and one of the attributes that we can bring to our markets is frankly investing our footprint geographically to ensure that we are on the ground and close to our customer base. That in turn allows us to enhance and refine our understanding of the market requirements and capture greater suite of data. So I think if I can answer in very short terms, we're going to be quite disciplined in respect of where we go next. The opportunity for us in India in particular, but Indonesia as well, is so immense. Our focus is here. Positions were made here. This was essentially a greenfield established business. So we identified the opportunity that we've been discussing already this morning, driven by the investment thesis of everything that I'm sure you report on very regularly with respect to the Indian macro story. We have invested a significant amount of money in respect of building out the operations that Mukund introduced, including the 6 regional locations where we have a number of our people. The most demonstrable evidence of our investment has been the acquisition of Reom.ai. Reom.ai has a product called LoanGuard. LoanGuard uses artificial intelligence and machine learning to screen applications on behalf of lending institutions before disbursement, so before a loan is paid out. And for us, that was a very, I think, symbiotic acquisition because A, it allowed us to leverage technology in a way that we felt was quite unique in the market, but also spoke very much to our core strategic aim of building a tech-enabled credit management business. So that acquisition we saw as an accelerant to where we want to go in the business. And we are speaking at length with the development team around how we evolve the offering to go from pre-disbursement to post-disbursement. I think it touches on your earlier question, ma'am, in respect of what value can we add to, say, some of the smaller ticket exposure, particularly in more of the fintech side of the business. I believe tools and capabilities like LoanGuard is a very, very powerful way to do that. Would we make investments in India going forward? We absolutely will. We assess every investment on its merits. We look at it through the lens of growth and cost of capital and return on equity and all that sort of stuff. We are a standalone capital allocator in that regards. But if it can enhance our wider offering and if it reiterates and supports our strategy, we most definitely will. We're exploring various options at the moment. Won't go into those right now. Suffice to say they explicitly fit the strategic intent that I just walked through earlier on.
Can you put some number,
Cumulative number of capital invested.
Yeah.
So let's just say if I can use euros for the moment, I would say it's more than 8 but less than 10.
Turnover in India so far, and what kind of targets do you see with all these investments in place going ahead 2 years, 3 years down the line?
Yes. Let's just say I'm not going to give you absolute numbers in respect of turnover. My aspiration is that we are growing over the next 5 years at a 30% cumulative annual growth rate. That is our goal. And if we don't achieve that, I think we've missed the opportunity in reality, because I do believe what we're building here has a genuine need in a very, very large market.
Thank you.
This is Sachin from APN News. How do you ensure lower risk for both lenders and borrowers? First question, and especially for the lenders.
Yes, I see. So perhaps a good way to answer that is a sort of broader understanding of our wider client base. So in a number of our European markets, we work with lenders who will originate a loan and then via an API interface will complete that loan directly onto our core loan management system. Now, I've long been of the view that the best way to assess risk when it comes to credit origination, particularly retail, is after the loan has been dispersed, not before it. Before it, you get one chance to understand and underwrite a borrower. You build a file. That file could use very obvious data. It could use a wide degree of data, but you touch it once. Whereas post-disbursement, you're touching the borrower, quote unquote, multiple times per annum, typically monthly, and if they've gone into some form of difficulty, it could be more often than once a month. So you get access to more data. Now, what that allows us to do is to turn around and strategically inform our clients in respect of where there are pockets of risk emerging in their origination and underwriting policy. And what we've done with a number of our clients in the UK in particular is work proactively with them to refine not only their underwriting but also their product offering and their origination capabilities. So that's a very obvious example. It's more post-disbursement. The immediate example here in India is through the use of LoanGuard, where we are seeing some staggering growth rates, clearly underpinned by India's immense GDP growth year on year of 7.2%. You're seeing retail credit growth growing at nearly 2x system. So you're seeing growth of 14% in some instances. There is clearly going to be evidence of risk as a result of the pace of evolution. That is where we can come in with the tools that we're able to drive. In totality, however, we see it both pre and post-disbursement. Pre-disbursement I would call more tactical. Post-disbursement I would call more strategic.
And do you cater to the defense sector for line of control?
Not as of now.
It's a good question. We have actually had a go at that in the last year, and we had a go at it through the lens of trying to invest in small portfolios that were being sold by some of the institutions. And it was an interesting experience for us. The quality of assets that were being sold were very attractive. The return profile was interesting. However, because our investors that we work with invest using US dollars, the swap from the rupee to US dollars reduced the return on capital to such a degree that the risk-return analysis didn't make sense. It's important to think about that through the lens of the return availability in the US and Europe. Going back now 6 to 12 months, you could put capital to work in their home markets at a much greater degree of return than you could previously. So we've decided as a business strategically that it's too early for us to do that. And one of the ways we think about a business like what Milkland is building is it's a very capital-light way for us to learn about the credit fundamentals of the market. We would rather build out the operation, learn more about the market, and then look to put capital to work. So I couldn't put a date on it for you, but I would like to think in the next couple of years we'll be putting our own capital to work into portfolios.
Just to add to what Fraser is saying is that if you look at how the Indian market behaves in terms of pricing of these NPLs, we still have that alignment to come to the market expectations. If you look at what gets put up by the lenders in the market for sale and what actually gets sold or bought by the ARCs, the conversion ratio is hardly around 15%, 20%, right? 80% is remaining unsold because the price expectations today in the market are unrealistic. So I think that there's going to be a time where we align to the global pricing expectations, and that's when you'll see a very strong